I want to tell you about two friends who made completely different investment decisions in 2015. Both started with $100,000 to invest. One chose a simple growth ETF and let it ride. The other tried to be clever, jumping between trendy stocks and chasing hot tips. Fast forward to today, and the first friend's account shows $436,000, while the second barely has $200,000. That's a $236,000 difference from one simple decision. Here's what's crazy. I'm about to show you 6 growth ETFs that could be the difference between retiring comfortably at 65 or working until you're 80. The friend who won? He picked one of the ETFs I'm covering today. By the end of this video, you'll know exactly which ETF fits your risk tolerance and growth goals. You'll understand why some have made people wealthy, while others have left investors disappointed. But here's the thing, this isn't a get-rich-quick scheme. This is about building real sustainable wealth over time. If you want to see your money grow like this, smash that like button and subscribe so you never miss a wealth-building strategy that could change your financial future. Before we dive in, let me explain why growth ETFs are your wealth-building weapon. Think of ETFs like buying a pre-built gaming PC versus building your own. You get professional selection, diversification, and optimization without the headaches of picking individual stocks. When you buy an ETF, you're essentially hiring a team of experts to manage a basket of stocks for you. Now, Warren Buffett once said something that changed how I think about investing. The stock market is a wonderfully efficient machine for transferring wealth from the impatient to the patient. These 6 ETFs are specifically designed for the patient wealth builders who understand that real wealth is built over years, not days. Here's how I'm ranking these today. I'm using S&P 500 overlap as my primary metric. The S&P 500 represents the 500 largest U.S. companies and has averaged just over 10% annually since 1957. The lower the overlap with the S&P 500, the more unique growth potential an ETF offers. This methodology will help you understand exactly what you're buying and why it matters for your portfolio. ETF number 1, Schwab U.S. Large Cap Growth ETF, ticker SCHG. Let's start with the Schwab U.S. Large Cap Growth ETF, ticker SCHG. I call this the steady wealth builder, and here's why. Meet Sarah, a teacher who started investing $500 every month in SCHG 5 years ago. She never tried to time the market, never panicked during downturns, and never got distracted by flashy stock tips. Today, her consistent investing has built a portfolio worth over $45,000 from just $30,000 in contributions. SCHG has a 54% overlap with the S&P 500, which means about half of what you own will mirror the broader market, but the other half is pure growth focus. This ETF holds 231 companies, but the beauty is in the concentration. The top holdings like Nvidia, Microsoft, Apple, and Amazon each carry between 6 to 11% weight compared to their 4 to 7% weight in the regular S&P 500. This means when these growth giants perform well, SCHG amplifies those gains. The numbers that matter? The expense ratio is just 0.04%, which means on a $10,000 investment, you pay only $4 per year in fees. That's less than a single coffee at Starbucks. Over the past 10 years, SCHG has averaged 15.8% annual returns compared to 12.8% for the standard S&P 500. If you had invested $100,000 in SCHG 10 years ago, you'd have approximately $436,000 today. But let's talk about the reality of risk. SCHG's best year delivered over 50% returns, but its worst year saw a 31.8% decline. The standard deviation sits at 18.08%, which means you need to be prepared for some serious ups and downs. This ETF is perfect for beginners who want growth without going completely crazy with risk. ETF number 2, Invesco S&P 500 Momentum ETF, ticker SPMO. Next up is the Invesco S&P 500 Momentum ETF, ticker SPMO. I call this the trend surfer, and here's why it's fascinating. What if you could automatically ride the wave of winning stocks without having to constantly research and pick individual companies? That's exactly what SPMO does. This ETF only selects stocks from the S&P 500 that have the highest momentum scores. Think of it as investing in the companies that are already winning and showing strong upward trends. The fund rebalances twice a year in March and September, constantly updating to catch the latest winners while dropping the losers. SPMO has only 35% overlap with the S&P 500, making it much more unique than our first choice. It holds 99 companies with top holdings like Nvidia, Meta, Amazon, Broadcom, and JP Morgan, each making up 5 to 10% of the fund. The technology exposure is lower at just 22%, giving you more sector diversification. The performance numbers are impressive. Over the past 10 years, SPMO has averaged 16.78% annual returns. In the past year alone, it's returned 30.52%. The standard deviation is 16.45%, which means it's actually less volatile than our first pick while delivering better returns. The best year delivered 45.8% gains, while the worst year only declined 10.46%. This ETF is ideal for investors who want to catch trends without becoming day traders. You're essentially betting that winning stocks will continue winning, at least in the medium term. It's more exciting than a boring index fund, but less risky than trying to pick individual momentum stocks yourself. ETF number 3, Vanguard Information Technology ETF, ticker VGT. Now let's talk about the Vanguard Information Technology ETF, ticker VGT. I call this the innovation engine, and here's why it deserves your attention. Every smartphone you touch, every AI breakthrough you hear about, every digital revolution that transforms industries, they all run through this ETF. VGT is a pure technology play with 319 holdings focused entirely on the tech sector. The top companies include Apple, Nvidia, Microsoft, Broadcom, and Salesforce. When you invest in VGT, you're making a bet that the future is digital. And honestly, look around. Is there any doubt about that? The concentration in semiconductors and system software means this ETF captures the core of technological innovation. The expense ratio is reasonable at 0.09%, and there's only 33% overlap with the S&P 500, giving you focused exposure to tech growth that you can't get from a broad market fund. The performance has been spectacular for patient investors. Over the past 10 years, VGT has averaged 19.8% annual returns. Think about that, nearly 20% per year for a decade. The past year returned just over 14%, which might seem modest, but the 3-year average is 19.7% and the 5-year average is 19.2%. But here's the double-edged sword of sector concentration. VGT's best year delivered 52.6% gains, making investors feel like geniuses. But the worst year saw a 29.7% decline, with a standard deviation of 19.98%. This means you need to stomach some serious volatility. This ETF is perfect if you believe the future belongs to technology companies. If you think artificial intelligence, cloud computing, semiconductors, and software will continue driving economic growth, VGT gives you concentrated exposure to that thesis. Just remember, sector concentration means higher rewards come with higher risks. ETF number 4, VanEck Semiconductor ETF, ticker SMH. Here's where things get really interesting. The VanEck Semiconductor ETF, ticker SMH, is what I call the semiconductor superstar. This ETF turned $10,000 into $73,300 in its best year. Let that sink in for a moment. But before you get too excited, let me explain why this is the highest risk, highest reward play on this list. SMH has only 26 holdings, making it extremely concentrated. When you buy SMH, 20% of your investment goes directly to Nvidia, 10% to Taiwan Semiconductor, and then Broadcom takes another significant chunk. The top 10 holdings make up 82% of the entire fund. This is the opposite of diversification. This is a concentrated bet on the semiconductor industry. Here's the thesis. Semiconductors are the building blocks of our digital world. Every car, phone, computer, and AI system depends on these chips. As technology advances, as electric vehicles become mainstream, as artificial intelligence explodes, the demand for sophisticated semiconductors should skyrocket. SMH gives you direct exposure to this trend. The performance has been remarkable over the long term. Despite returning only 0.13% in the past year, the 10-year average is 24.51%, the 3-year average is 26.1%, and the 5-year average is 28.51%. These are exceptional returns that few investments can match. But here's the reality check. SMH has a standard deviation of 26.2%, making it the most volatile option on this list. The best year delivered 73.3% gains, but the worst year declined 33.52%. This sector is highly cyclical, affected by supply and demand imbalances, geopolitical tensions, and trade policies. This ETF is only for investors who can handle serious volatility and believe deeply in the semiconductor industry's long-term growth. If you can't sleep at night when your investments swing 30% in either direction, this isn't for you. But if you can handle the ride, the potential rewards are substantial. ETF number 5. Avanti's U.S. Small Cap Value ETF, ticker AVUV. Now here's where I'm going to challenge your thinking. The Avanti's U.S. Small Cap Value ETF, ticker AVUV, might be the best growth play of all, even though it's technically a value fund. This is the contrarian's choice, and here's why it deserves your attention. I learned about the power of small cap value from financial expert Paul Merriman, who has researched decades of market data. Here's the counterintuitive truth. Small cap value has outperformed large cap growth over the longest periods of economic history. The data gets even better the longer the time horizon you examine. Since 1972, small cap value has achieved the highest returns of all equity categories. This isn't theory, this is historical fact. AVUV invests in 795 small companies trading at low valuations but with higher profitability ratios. These are quality companies that the market has temporarily overlooked. The fund has 0% overlap with the S&P 500, giving you complete diversification away from large cap stocks. Only 6% of the fund is weighted toward technology, spreading your risk across multiple sectors. Companies like Five Below and Urban Outfitters represent the type of holdings you'll own. Here's where it gets interesting. AVUV's recent performance looks terrible. Over the past year, it's returned only 2.31%. The 3-year average is just 6.7%. This is exactly why most investors avoid small cap value. The recent performance is disappointing, but the 5-year average is 19.47%, and historical data suggests this asset class delivers superior long-term returns. The fund has the highest standard deviation at 28.28%, meaning maximum volatility. The best year delivered 42.2% gains, but the worst year declined 8.3%. The expense ratio is 0.25%, which is higher than our previous options but still reasonable. You'll also receive a 1.75% dividend yield. This ETF is for 10-plus year wealth builders who can ignore short-term performance and focus on long-term wealth creation. If you need your investments to perform well every year, this isn't for you. But if you can be patient and contrarian, small cap value might be your secret weapon. ETF number 6. Invesco S&P Mid Cap Momentum ETF, ticker XMMO. Finally, let's discuss the Invesco S&P Mid Cap Momentum ETF, ticker XMMO. I call this the Goldilocks investment. Not too big, not too small, but just right for many investors. XMMO focuses on mid-cap companies with the highest momentum scores from the S&P Mid-Cap 400 Index. These are companies that are larger than small caps but smaller than large caps. They're in the sweet spot of having room to grow while maintaining some stability. The fund holds 80 securities, with Interactive Brokers leading at nearly 5% weight. The top 10 holdings make up 30% of the fund, providing reasonable concentration without going overboard. You get only 8 to 9% exposure to technology, spreading your risk across multiple sectors. Here's what makes XMMO special. It has 0% overlap with the S&P 500, giving you complete diversification away from large cap stocks. The 10-year average return is 15.18%, which is solid performance with less drama than our previous options. The standard deviation is 19.75%, meaning moderate volatility. The recent performance shows consistency. The past year returned 9.3%, the 3-year average is 16.38%, and the 5-year average is 16.7%. The best year delivered 38% gains, while the worst year declined only 16%. This represents steady growth without extreme swings. The expense ratio is 0.34%, which is the highest on our list, but you're paying for active momentum screening and mid-cap focus. You'll also receive a 0.67% dividend yield. This ETF serves as the stabilizer that adds growth without the chaos of our more volatile options. Now let's talk about how to combine these ETFs for maximum impact. I recommend a core satellite approach, starting with SCHG as your foundation because it provides steady growth with reasonable risk. For conservative investors, consider 70% SCHG and 30% SPMO. This gives you growth-focused large caps with some momentum exposure while keeping volatility manageable. You're essentially building a growth portfolio with two different strategies. Moderate investors might prefer 50% SCHG, 30% VGT, and 20% AVUV. This combination gives you large cap growth, technology concentration, and small cap value diversification. You're covering multiple market segments while maintaining growth focus. Aggressive investors could consider 40% SCHG, 25% SMH, 25% VGT, and 10% XMMO. This portfolio maximizes growth potential through semiconductor and technology exposure while using SCHG and XMMO to provide some stability. The key is rebalancing. Review your portfolio quarterly, but only rebalance annually unless allocations drift significantly. This prevents overtrading while maintaining your target risk level. Remember, the goal is consistent long-term growth, not perfect timing. Most importantly, start with just one ETF that matches your risk tolerance. You can always add others later as you become more comfortable with investing. The perfect portfolio that you never start is worthless compared to the good portfolio you begin today. Your next step is simple. Pick your risk level and start with just one ETF. If you're conservative, begin with SCHG. If you want more growth, add SPMO or VGT. If you're willing to accept higher volatility for potentially higher returns, consider SMH or AVUV. Imagine where you'll be in 10 years if you start investing consistently today. That friend I mentioned at the beginning, he didn't have some secret strategy or inside information. He simply chose a quality growth ETF and invested consistently for a decade. The compound growth did the rest. If this video helped you understand growth ETFs better, hit that like and subscribe button for weekly wealth building strategies. I break down complex investing topics into actionable advice you can actually use. The notification bell ensures you never miss new content that could impact your financial future. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.